Stephane Nasser, who is a co-founder and CEO of OpenVC, a free-to-use fundraising platform that has facilitated over $1 billion in startup funding for more than 25,000 founders.
If you care about getting access first, that's going to be on OpenVC. You literally have nothing to lose. We don't take any cut, any equity, any success fee. You want to build your small startups because you can be acquired by Salesforce or whoever for $1 billion plus. So it's exciting for you. Big companies don't innovate so much. It's not exciting for investors. They like I said, the FOMO. They like the hunt.
How to create this FOMO effect, this fear of missing out effect in the right way. Good morning, good afternoon, good evening, everyone. Here is Viktor Arlovsky and podcast Ventures from the Valley, which is brought to you by R136 Ventures. And today we're speaking to an exciting person, an activist, Stephane Nasser, who is a co-founder and CEO of OpenVC, a free-to-use fundraising platform that has facilitated over $1 billion in startup funding for more than 25,000 founders since its launch in 2021. OpenVC database now includes over 6,000, I saw 7,000 already investors across capital firms, angels, networks, family offices, accelerators, name it. And there are 500 pitches which flow through the platform weekly. So beyond building infrastructure, Stephane is a educator on fundraising best practices, reviewed thousands of pitch decks, and published extensive guidance on common mistakes, systemic approaches, and data-driven storytelling. So we will speak about that. So welcome, Stephane, and I'm sure we will have exciting podcast today.
Hi, Victor. Hi, everyone. Thank you for having me. And I'm very, very excited to jump into this conversation. Lots of things to discuss.
Yeah, indeed. Totally agree. So let's start with maybe what did I miss from my short intro? Is there anything you would like to add, colors, any flavors of your biography?
No, man. I mean, you've been very comprehensive. This is probably the best intro I've ever had. Thank you for that. No, so we build, like you said, infrastructure. We try to build pipelines that allow deals to flow between founders and investors. We focus on early stage tech companies. So if you're a biotech founder in New York City, if you're a SaaS founder in Berlin, and you're trying to raise pre-seed, seed, or Series A for your startup, well, you're probably going to end up on OpenVC at some point. Build your investor list on OpenVC, reach out to investors, find intros on the platform as well. We have a tool for that. And that's half of what we do, building tools for fundraising with my co-founder. And the other half is content, education, homework for founders, basically the basics. Like a lot of founders, if you just give them the tools, right, they're going to make mistakes again and again and again because, they never learned how to raise. It's not something you learn in school.
Mm-hmm.
So we quickly realized if we want to help, we also have to provide contents, guidance, and that's what we do with all the blogs and playbooks and webinars.
Okay, sounds good. So let's dive into OpenVC, and indeed, it's like an exciting journey in such a short period of time. So how did you come up with this idea? So I know it was like your part-time work in the beginning. So maybe you can just give a little bit of your journey. So why and how did you decide to do OpenVC?
Right. You're correct. It was a side project for the first 2 years. So 2021 to 2023, something like that. It was a side project with my co-founder because we just weren't too sure where to go with that. But the origin is actually older than that. I started my first job out of business school was in a startup accelerator, Microsoft Accelerator in France. And that's where I saw founders, we were working with a small batch of tech founders, helping them in many things, including fundraising. And I saw the same pain points reappearing again and again. And at the time, this was kind of an itch I wanted to scratch. Then I moved to the US. I've done a bunch of things. And then later on, I had the opportunity to come back to that problem with better technical skills and better understanding of the space of the industry. So that's when I really started OpenVC. But yeah, it's been like 10 years in the making, or 10 years in the cooking, right? Cooking in my head, brewing in my head. And we finally like built and launched early 2021.
So basically, OpenVC is indeed a disruptor for people like me for doing like very classical venture. So how do you differentiate yourself? I mean, there are still a lot of platforms like you, right? I mean, OpenVC is in a very competitive space. Whom do you compete? First of all, if you think about yourself as a startup, you would have this differentiation slide where you would put 5 or 10 of your competitors with all this minus, 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 or half, 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 and you will be just very bold and pluses, pluses everywhere. So let's deep dive into how different OpenVC from and from whom and how. So
okay, so I'm not going to break it down by features because I think it's not the right way to approach it. I'm just going to define it by needs and use case and who we help. Basically, let's say you're raising Series B plus, right? Raising a larger round. You're probably going to work with an investment banker, or you're going to work with, are you going to have a CFO leading the charge? And that's not for us, right? We don't work with those people. They have white glove services, and the fundraising amount justifies it. If you are, from angel round to Series A, and it's like your first or second round, usually you're what I call a headless chicken in most of the cases, right? You're just running around, bumping into the walls. And unless you have experience in the startup space, unless you have been for an accelerator or something like that, but for 90% of people, you're a headless chicken. And so we try to give you the cockpit or try to give you the steps and the tools to fix that. So in that situation, you could say we compete with accelerators because we educate founders. We compete with people selling investor lists or selling fundraising CRMs or selling pitch deck tracking. So you could say that we compete with DocSend. But our approach, I would say, is quite different because we are only in one platform. And we don't just provide the tools, but we also provide the access. That's, I think, difference number one. Investors sign up to our platform and they tell us, okay, I want to receive this kind of deals and I want to be contacted via email or via form or via intro. And so founders, they don't just get the tools, but they have the network plugged into the tools. That's number one. And second difference, so that's the two axes. You say you wanted two axes, so these are the two axes. Number two, we don't charge any success fee or any equity. Most people, 95% of our users use OpenVC for free, and that's completely fine because that's the reality of this market, right? And then 5% of founders want advanced features and they upgrade for a premium subscription, and that's how we make money. So just make money with a monthly or annual subscription, and that's it. And so that way we don't, we don't take a slice of the deal, we don't take a slice of the pie. And because of that, we can work with a lot of people. Accelerators actually use OpenVC, sometimes buy premium and give it to their founders. Fundraising advisors, fundraising consultants use OpenVC to raise for their clients, right? Because we're not taking a slice of the deal, so we can play nice with everybody. We're not a direct competitor. And we enable and empower a lot of people rather than competing with them. I don't know if that makes sense.
It does. It does, absolutely. So may I think of OpenVC as a two-sided marketplace where you connect investors and founders, basically, but you charge only founders, from what I understood. Like, I mean, on a freemium model, right? So it's like a freemium two-sided marketplace.
Correct. A big difference with the marketplace is that we don't process the transaction. That's an important difference. The deal is not closed on OpenVC. So a traditional marketplace, you have the payment and the transaction on the website. We don't do that. So if you want to close the deal, on with Carta, with AngelList, outside of the platform, it's perfect. And we love all these people. We don't compete with them.
And why don't you think of developing this functionality for me as an angel investor? And I use a bunch of platforms, and I think that what AngelList is doing is like a perfect fit for at least my purpose, because everything is in one place, and they take care of all my tax documents and payments, so I don't need to bother myself with a bunch of stuff which is like time consuming and boring. Is there are there any plans to jump into this? I mean, in marketplaces, it's called 3PL. When you deliver and get a payment for what you deliver, so is it something what you're going to launch anytime soon?
Do you think we need another AngelList or another, Sidecar, Carta, any of those guys? I mean, we're just gonna be one more player in the space, and not gonna bring a lot of, differentiation, in my opinion, or newness. Right? They're already doing a good enough job, so maybe we can do it 1.5 times better, and that would be hard. But let's assume we can, right? It's not like it's not the problem that we want to solve. The problem we want to solve is access, initial access. That's the broken part, in my opinion. That's where we add value. If you can use AngelList, go use AngelList, is what I tell founders, because they have someone else. I'm not married to anyone, right? But the part where I really want to bring something is the discovery phase, the top of funnel. That's what I'm interested in.
Okay, sounds good. So this requires actually a lot of thinking behind go-to-market strategy, right? So you have to advertise OpenVC quite broadly, and now you have a chance. Although our audience is not very large, but still it consists of mostly founders and mostly investors. So you have a chance to advertise yourself for like 60 seconds. For each group of your two-sided marketplace audience. Let's start with startups first. So why a startup should choose OpenVC? So you have 60 seconds to advertise as much as you can. Why it is?
Well, because it's probably the easiest and most comprehensive platform for fundraising. You're going to find like all the tools, all the data, all the access that you need, bundle into one package. I care a lot about UX. I'm a nerd when it comes to this kind of stuff. So we designed it in a very, very smooth way where everything lives in one place. So you're not going to, for example, not going to have to jump from a tab to another to see your deck analytics and then your CRM. Everything lives in one place. And it's just, when you're a founder, you don't have time to waste, right? You just want to cut the chase. And that's what OpenVC does for you. You're going to have all your raise in one place, all the data in one place, and you're operational, within 5 minutes.
That's a perfect advertising pitch for startups. And what about investors? Why investors should choose the platform? Why should they keep investing with OpenVC?
So, I'm not going to give you the answer. I'm going to let someone else talk. There's this angel investor on OpenVC called Francis Santora. He's from New Jersey. He's done 3 deals on OpenVC, I think. And he said that basically it's either you find deals on OpenVC first, or you find them later, on AngelList or any SPV, and you pay the fees. So if you care about getting access first, right, before the deals, have been seen by 100 people and are marked up, that's going to be on OpenVC. And again, you literally have nothing to lose. We don't take any cut, any equity, any success fee. So it's a no-brainer.
So it's at least something what you should be present at, right? I mean, you may be present. So would you say that like all your investors, I mean, how would you advise them? Should they only be like OpenVC uh, platform users, or you would advise them also to be like in different platforms and to like broaden this funnel through different investment theses? How would you make it like work for your
So I think,
potential
yeah,
investors?
for an investor, there are two benefits to using OpenVC. Number one, it's just exposure, presence, building your brand. When you're on OpenVC, you have an OpenVC profile. It will be seen by hundreds of founders every week. It will rank on Google. It will provide you with a backlink. It will allow you to tell your story with clarity, and you will be kind of an open investor, right? You belong to those modern, forward-thinking investors who are part of the OpenVC community and believe in that. So that's the first thing. And a lot of investors told me, I joined the platform because it's an hygiene problem. Like, if I want to have a clean brand, I need to be there. It's just part of a marketing strategy for them. So a lot of people join us just to have the names, because you have tons of other funds. They don't want to be absent from the party. That's reason number one. And then after that, they realize, okay, I'm actually receiving good deal flow, because on OpenVC, you can say how you want to receive deals. And then if you receive via email, we filter the deals for you. So you're not going to get spammed. You're not going to receive irrelevant, out of scope deals. You will receive deals that are curated, filtered, and that are a good fit for you. And we protect your email address from founders, so you're not going to get spammed and all the bad stuff that can happen. So yeah, be on OpenVC for the brand first, and then for the deal flow second. And yeah, you'll be a happy investor.
Sounds good. So a little bit more, let's speak a little bit more about marketing, and then we can switch to add value. I think that it is like an important question, and how do you add value to founders and investors? So I would definitely focus on founders first. But before that, you launched OpenVC on Product Hunt in March 2021. So you famously became a product of the day and the product of the month, and you were nominated for a product of the year.
Yep.
So in 2-3 weeks, you really collected a lot of traction. So maybe you can open a little bit of secrets how you maximize this visibility. So also it would be interesting to know what happened in like 24, maybe 48 hours after this event. How did you become famous? It's like it was your moment of truth, I think. But I think it was an exciting moment for you. So maybe you can give
Oh
a
yeah.
little bit of insights. How did it all happen to be?
Yeah, that was super exciting, man. We didn't sleep. My co-founder came to my apartment in Paris at the time, slept on the couch, and we literally spent, I think, 36 hours awake. We plugged, like, I had a TV. We plugged the laptop on the TV to have the numbers, in real time,
Mm-hmm.
and
Mm-hmm.
we were just stoked and all in. And I mean, this was a lot of fun, honestly. And I think that's the key. I mean, I'll break it down like how we did it.
Mm-hmm.
Bottom line, we were obsessed and we were
Mm-hmm.
excited. And so you just have this energy flowing, and whatever happens. Yeah, we're going to have a lot of fun, and we're going to bring everyone on board. Okay, so that's the small story. The big story,
Mm-hmm.
I published a whole blog post about everything we did that day and all the little tricks and techniques we used. Now, a lot of that is not valid anymore. Product Hunt has changed a lot in 5 years. So just for people listening, maybe today, the game is different. Product Hunt doesn't get so much reach, or it's harder to play with. We prepared for that. Actually, what we did is we did a first product launch a few months before to get familiar with the platform, to gain some followers, and yeah, just to build up momentum a little bit. think it was like 3 months before. Number two, on the D-Day, we had really planned things very well. We had these spreadsheets with each time zone because you want to hit people on different time zones. We were in Paris at the time. So you have to like nail when Americans wake up, right? There's a huge crowd, but you can already start with Europe. And that was, I think, a strength for us because Product Hunt launches start at midnight, I think Pacific time, which is like 8 a.m. or 9 a.m. I don't know in Central Europe or Western Europe. So it's perfect for us because when you launch, you can have a big boost because our network is in France and Germany and the UK. So we have a big boost. We land on the first page, the top 5 products of the day. And then after that, more people see you. So there is a kind of self-fulfilling prophecy or positive cycle. Because if you're in top 5, you're more likely to stay top 5. If you're not in top 5 in the first 2-3 hours, you're probably never going to be. And after that, we just spent the day telling everyone about it. LinkedIn, Twitter, Slack groups, WhatsApp, Telegram, Signal, what else? Just everybody. Hey, go check it out, upvote, please support us, blah, blah, blah. Newsletter. Yeah, we had built a newsletter too. We used that. Reddit. Reddit was important for us too. Yeah, that's what we've done for nonstop. And we really, at some point, some guys passed in front of us. We were really tired, 18 hours into the day. We're exhausted. We didn't give up. We thought we had lost, but we just went, all in. And those guys, after the fact, actually got disqualified by Product Hunt because they were using some bots or something. That was, I cannot tell you how happy I was. And yeah, ended up product of the day. And then I think, it resonated with people because we really put our story out there, right? 2 guys building in a living room. It was a lot of open source, community-driven stuff at the time. Still is. I mean, there's still an open data part to the project. And so a lot of people vibed well with that philosophy, right? Like, okay, venture capital is closed, we're going to open it. So people like the brand, people like the mission, and that's why they supported us.
That's an exciting journey, indeed. By the way, I just wanted to ask you, who's your co-founder? How did you meet? I think it's important for founders. I mean, they always like looking for someone whom can they journey with.
Yeah, absolutely. His name is Lucas. He's a French guy like me, and I met him on a Facebook group.
Wow.
On a Facebook group of all places during COVID. I just started OpenVC. I had the database. I needed to build the front end for it, and I didn't know how to do that. So I went to this Facebook group and I said, "Hey guys, here's what I've built. How can I do the front end? Do you know any tool I can use? Any no-code tool?" And the first comment is, "Hey, I don't know any tool, but if you want, I can build that for you, and for free, like because it's a cool project." We worked for maybe a year without ever meeting each other in person. I think the first time we met in person was the day of the launch, where he drove from the north of France to Paris to meet me. We never met in person before.
Wow, that's a very unusual setup for a company. That's amazing. So, how big is the team now, and can you consider yourself a software house?
Software house. We're a software company, definitely. We're not a consulting firm or anything like that. We're not a venture capital firm. The team is Luca and I, and we have 6-7 people working with us as well. Some part-time, some full-time, in different capacity. Something that I really like, how we structured that. So everybody's remote, everybody's asynchronous. We had, like, in 5 years, we only had one all hands meeting. Otherwise, a lot of people have never met each other, or we're extremely decentralized. We have people all around the world. We have one guy in San Francisco, one guy in Miami, one guy in London. Luca in France, etc., etc. So yeah, it's and it works well for us. We like that. We like working this way. I think Luca is also happy with this setup. I'm travel a lot myself, just like you, Victor. So
Mhm.
it fits my lifestyle and it fits Luca's. It fits our identity, I would say. It's probably not good
Mhm.
for every company, and it has downsides. I'm not denying that, but for us, it worked very well.
So, and how many of those 7, 8 people are engineers, sales, marketing? I mean, can you just break a little bit into like the roles?
Yeah.
I'm sure you are like a startup. Everybody's doing everything, but still. Um,
No, no, no. No, actually, that's a good question. Only one guy is truly a coder, developer, engineer. It's my co-founder, and the
mhm,
rest of the team, this is all marketing, basically,
mhm.
all marketing.
Okay.
Our product is very
Okay.
simple. The real challenge is, like you said, like making some noise, being noticed, driving traffic,
Mhm,
acquisition, etc.
mhm, mhm.
We are hiring now one more person on the technical side. So if someone's
Are you hiring?
interested,
Are you hiring through the platform, by the way? Do you have like the uh, like funnel for like maybe some of startups want to join you? Do you advertise it on the OpenVC platform? Your um,
I'll post
open
that on the
positions,
newsletter.
OpenVC open positions.
Yeah. So we don't have like a job board right now. Although sometimes people ask us for that.
And it
Um,
might be an interesting stuff, by the way, because VCs after they, I mean, next thing after they raise money, it's not like all about going product or going sales. It's all about hiring, right? You
yeah.
basically raise money to hire more people, and then these people are doing marketing or sales of a product or software, right?
Yep. Yeah. Completely right. We have some ideas in that direction. Something maybe. So we're experimenting with some stuff. Soon we're gonna start an internal project where basically we match. So we try a lot of stuff on the side. Something I didn't say. There is a lot of stuff behind the curtains that we try and we never ship. So right now, something we're going to start trying is matching, top talents, triple A um, builders with startups that raised and with very good startups of the platform, and having compensation part in cash, part in equity, and allowing those top builders to build a little portfolio with their skills, like a little venture portfolio, basically, and those startups to incentivize uh, top talents they could not get otherwise, and also better control their cash, right? Not spend everything up front. So it's an experiment. We'll see how it goes. But I think there's a lot of ways to be creative. We could do a job board, but again, there's a million job boards that already exist. Not sure we
Mhm,
would bring a lot to the table. We're better with equity stuff.
mhm. Well, yeah, yeah, I totally agree that with like so small team, you should focus. And from what you're saying so far, it looks like you are like very laser focused on this top funnel and meeting or connecting investors and founders. And I think that that's really what most founders are missing, and most investors are missing too, right? I mean, so it's the connection point. Um, do you measure and how do you measure success? By the way, so are there any KPIs you measure yourself? What's your like North Star for KPIs? So how do you measure your say daily, weekly, monthly success? So
Yes.
most of startups do it either by user base, adoption, uh, screen time, deal flow, right? Revenue, LTV to customer acquisition cost, gross margin. So what's your dashboard? What does your dashboard look like?
Yeah. So model wise, at the end of the day, we are a SaaS company. So we're going to measure the same stuff as any SaaS company: MRR, retention, churn, customer acquisition cost, all this kind of stuff. That tells us our success as a business. That doesn't tell us our success, like the success of our users, because for our users, what matters is raising funds. So what we do is every quarter or so, we pull all our user list and we check with third-party databases if they raise or not. Because keep in mind, we don't process the transaction. So we don't know actually if people who use our platform, we don't know inside our app if they raised, because the raise doesn't happen in our app.
Mm-hmm.
So we compare with public information, all the database you can imagine, like have they had any raise, and that tells us, okay, they raised after using us. So that's one way. And for a long time, this was our only measurement, our only metric, like did they raise? And then something else we realized, being a founder and fundraising is not like one point in time, but is more of a curve or journey over a long period of time. You have a lot of people, they will start a startup, want to raise, but the truth is, honestly, they're not ready. They still lack some things to succeed, but they will learn, right? They'll spend 6 months, burn their cash, make mistakes, and fail. Then they'll go back to something else in their lives. And maybe 2 years later, they start a new startup, and this time they're successful because they're building on the previous failures. And so for 90% of our users, it's not about helping them raise. They will not raise. It's not because we're a bad platform. It's same with everyone. Venture capital is like that. It's, are we helping them growing as professionals, growing as entrepreneurs? And so that's why we put out all this content, the fundraising masterclass, the webinars, the blog, the ebook. And it's a big part of creating value. Like people come and they want to raise, they're not going to raise for a big chunk of them, but they're going to fail faster, understand better why, and then take that with them in their journey moving forward. So yeah, this is also something that I think about when I think about success. How do we help people grow as professionals and entrepreneurs and not just raise funds? Because otherwise you're only looking at 5% of users and ignoring the 95 other.
Okay, so I think that that's fair. So it's really difficult to put like very firm KPIs in the business you're in. By the way, have you ever raised money yourself? I mean, for OpenVC, are you planning to? Are you planning to
We're
use
not VC.
OpenVC platform to do this?
We're not VC backed.
Or you go to Sequoia.
No, I mean, look, I think like the business we're in, I love it, but it's not a $1 billion business. With the current model, you cannot get to 100 million plus in ARR. Okay, we're aware of that, and so this is not VC backable for that reason. So we're not going to raise funds, but also we don't need to. We're profitable. We're growing. So we have no reason to give away control for resource at this point. So no, we're happy where we are.
Although I think there will be plenty of interest to buy you guys, probably more established VCs would want to move into the space, and I may imagine that there will be some inbound interest for like some established players to acquire a company like OpenVC. I would think that people might like consider that. Will you ever sell?
We've had some conversation.
If you ever sell, what will be the reason to?
So yeah, very, very honestly, we've had some conversations with a few people at some point, but we're at the point where, for us, the growth we have and the situation we're at makes us very picky and very, very demanding. And on the other hand, the numbers don't make sense, which I understand, right? Because we see the potential and they see the current state of things. And so we cannot find a common ground, which completely fine. I completely understand. But for us right now, I still feel we're just scratching 1% of the surface. Like all our work, the brand we built, the product we built, this is just starting to pay off. I think we're just, at the start of the inflection point. So it's going to be hard to make this make sense financially for an external buyer.
Maybe we'll see. Who knows? So let's deep dive into a startup journey, right? So can you like walk us through so what startupper should do on your platform? How best he or she should utilize the platform to make it best outcome for a startupper. So maybe you can just go through the journey.
So it starts the same way for everybody. Sign up page. We're going to ask you like 20 questions. So we're going to annoy you, try to understand your company, where you're headquartered, do you have revenue or not, what industry you're building in, because this will allow us to customize your experience. Then you're on OpenVC.
To personalize, right? Just to make it very personal and engaging.
Mm-hmm. Exactly. So we'll generate an investor list that makes sense for you, and we'll, like adjust the experience based on what you tell us. Then after that, basically there are two directions. Direction one, you want to raise right now, you're ready to raise. So you're going to upload your pitch deck to OpenVC. We're going to host it, create links you can share with investors, track when open it, etc.
Will you help to build the deck if I'm not experienced?
So we have, when you upload the deck, actually, I think we're the only ones who offer that feature in a deck sharing solution. We give you a score and we give you some feedback. So it's okay, this is a deck you want to share with investors. It's a 3 out of 5. And here are 10 things you should fix, in our opinion. And so, that's helpful for founders because, again, a lot of them just are not aware. And it's simple stuff like 35% of decks don't include the email address of the CEO or any contact information.
They just forget. They just forget.
Yeah, exactly. Which, like, it's okay, but we can fix that easily, right? It's like 10 seconds to fix it. So why not? So exactly. So first, upload your pitch deck, and then you're going to build your investor list. And for each investor, we tell you how they want to be contacted. So again, some people, you can submit deck directly via OpenVC. We're going to help you build a little cold email, customized, something short to the point, based on the data you provide us at signup. So you use that to create your cold email. Includes a unique link to share the pitch deck, and send it in one click. We take care of deliverability.
Like DocSend, more or less, right?
Correct. Except we send straight to the VC inbox, right? So because DocSend hosts the deck, and after that, you're on your own. We have everything in one place. That's for the investors who accept cold outreach. For the others, investors who want an intro, we have a little tool that plugs to your LinkedIn and Gmail accounts, searches all your contacts, and finds mutual connections with investors. So you'll see, okay, you want to contact, Marc Andreessen. Here are 10 people who know Marc Andreessen, ranked by relationship strength. And so that way you can say, okay, so actually you didn't know, maybe one of your friends, one of your colleagues, someone, an advisor, can connect you to that investor. So instead of going around and asking everyone, hey, do you know A or X or Y or Z?
So it's more or less like LinkedIn, right? So many people, many founders knock my door in LinkedIn asking, Victor, do you have a connection to this? They do see that they have a connection. Can you just introduce us to this person or that person? So it's like a little bit of a LinkedIn strategy.
Yeah, but the problem with LinkedIn, like everybody's connected to everybody. So it doesn't mean much. Like I'm connected with 35,000 people. But if you ask me an intro to those people, I don't know them personally.
Oh yeah.
So it
But
doesn't mean much.
but
So what we've
hopefully
done
they
is,
do know you. Hopefully they do know you because they follow you,
yeah,
right?
yeah, you hope so. But LinkedIn now is a marketing tool. It's not really
Yeah,
a connection tool.
indeed.
So our tool, we also match that with Gmail information.
Mm-hmm.
So if you
Mm-hmm.
have exchange emails with people, we rank this person higher. If you have exchanged a
Mm-hmm.
lot of emails recently,
Mm-hmm.
we rank them even higher.
Mm-hmm.
Google Calendar as well. So if you had meetings with people, if you had
Mm-hmm.
calls with people, this is
Mm-hmm.
all information we can
Mm-hmm.
access and assess and use that to rank the connection.
Mm-hmm.
So it's much more accurate than just a LinkedIn connection in that sense. Yeah, and then after that, you have the little CRM in OpenVC, and you
Mm-hmm.
can just move the cards, from contacted to pitch to due diligence to like classic stuff. Nothing fancy here.
Mm-hmm.
Just a simple functional CRM tool.
Do you use any crowd wisdom, like social, uh, what do you call, uh, uh, like uh, like social capabilities of the platform to curate pitch decks and founders? For example, if there is a task force, other founders who want to dive in and uh, uh, basically curate other founders' decks, do you like allow
Mm.
people to do so? So that is like
Mm,
curated within the
yeah,
platform. Or you have any plans to
yeah.
do it in future?
Like peer-to-peer or peer review kind of thing. Yeah.
Yeah, a kind of a peer
We
review. Yeah, a second opinion, a
Yeah,
peer review.
yeah. It's a good idea. We don't do that exactly. We do have webinars, a deck review webinar. So we have someone in the team who's really good at that, and well, it's a guy in Miami, and he will get on a private room with founders, so little groups of 5 or 10,
Mm-hmm.
and for 1 hour he will review pitch decks and give feedback. And other founders are encouraged to also share their opinion. So this is what we do. This is part of the premium membership. So that's when you pay the subscription, you can access those kind
Mm-hmm.
of sessions.
Mm-hmm.
That's it. We don't have, so it's pretty basic, but it works. So, well, we have the next session is in 2 days, actually, day after tomorrow.
Mm-hmm. Mm-hmm. Please send me a link. I might join in by like paying off
Absolutely.
your premium subscription model. And I'm thrilled
I will
to
do that.
become one of your investors for sure. Um,
I will
by the
do
way,
that.
do you have any prominent? Maybe you could not name them, but maybe you can. I don't know. I think that the list of investors is not open, right? Though, like, I mean, I could not go and scan all your investors. I mean, or is it
Oh,
like
yeah, yeah, you
fully
can.
fully transparent? It is pretty transparent.
It, it is. It is. So, okay. So there
Yeah,
are
What if I
two.
what if I want to stay like uh, not not disclosing myself? Can I
Hmm,
just
okay.
be hidden behind the wall or something?
Uh,
Can I pay for that?
so okay. So there are like two or three levels to your answer. So first, the database. When investors sign up, they agree
Mm-hmm.
to join the database, and we're
Mm-hmm.
called OpenVC because the
Mm-hmm.
database is open. It's under Creative Commons license. So
Mm-hmm.
actually, anybody can download the database
Mm-hmm.
except for the email address. Of course, email address, that's personal information.
Mm-hmm.
But it's like we hold the database and we maintain it for the community. So you could get the CSV or the Excel sheets right now if you want it. It's free, just one button to download.
Mm-hmm.
You cannot use it to resell, you cannot use it to, but it's for the community. That's for the investors who signed up to the platform. We also have a chunk of investors that we source from public sources, from
Mm-hmm.
public sources. And so those guys are not in the database because they
Mm-hmm.
didn't agree
They didn't
to be
sign up.
there.
Yeah. Mm-hmm.
Exactly. But they are still listed for founders,
Mm-hmm.
so they can be found.
Mm-hmm.
Now, if you are a user and you don't want to be in there specifically, you're allowed because that's the
Mm-hmm.
law, actually. So you send me an email and I can disable your profile if you really want.
Mm-hmm.
But
Mm-hmm.
it's kind of defeats the purpose. I mean, you want OpenVCs to be visible and exposed. But yeah, it's technically possible if someone requests it.
I can imagine that if I'm like a prominent a venture firm and I want to be on the platform, I don't want to create too much noise that I'm sourcing from the platform. By the way, do you have any like big established venture capital firms that are investors, like registered investors in OpenVC?
Oh yeah, we have a bunch. You can, and anybody on the platform that has the verified check mark,
Hmm. Hmm.
they signed up to the platform. So
Hmm.
that's,
Hmm.
I mean,
And you
right
have
now there's like,
VCs like large VCs that signed up, right?
yeah, yeah, absolutely,
Hmm.
yeah,
Hmm.
yeah, absolutely.
Okay.
Again, because for them, like I said, it's a hygiene question. Like if um, if Sequoia is here, then A16Z has to be here. But
Sure.
now, I mean, that doesn't mean you will raise from them for founder. Like they are here, they're listed because they're also listed on Crunchbase, they're also listed on Signal or any other base. Um, the ones that are the most active on the platform are smaller investors, right? Micro VCs, solo GPs, right? The long tail.
Hmm.
I mean, there
Hmm.
is like 10% or 5% of big names that everybody knows, but those guys, they source from the network mostly, right? They source from intros. And the most active ones for us, they are the smaller investors who are hunting, the ones who still want to build their brand, they still want to build their track record. So those guys, they're hungry, they're on the hunt, and they use OpenVC all the time.
Do you have founders who raised more than one round through OpenVC?
I don't know that. I think there's one. I think I think the guy from Bashcast. I would have to check. I don't know right now. That's quite specific. I think we have one that I know for sure because he actually messaged me. So sometimes they just message me.
Hmm.
They message me and they say, "Oh, Steph, by the way, we just closed the deal on your platform,
Hmm.
or we just invested in a startup we found on your platform." Because that's how I
You're
learn about it. Like I cannot see it.
you're a godfather of the platform, so obviously a founding father. So
I'm the
you're the
I'm the
one to
ghost
write.
inside the machine. Yeah, yeah. No, but man, that's really cool. I have this like this GP of it's a GP. So I told you I live in China right now,
Mhm.
uh, most of the year. And there is this GP of an American fund, but he's Chinese himself. I met
Mhm.
him in Shanghai, and like he signed up to the platform. A year later, he messaged me on WeChat, the Chinese app.
Yeah, yeah.
Hey Steph, we just invested in a startup, right? So that's that's how we do it. It's working well for us. It's working well for the users. I don't have like the exact number of like repeat founders. We probably should track
Mhm.
that. But yeah, right now I cannot. I think there's one that I know for sure. The others I don't know.
Okay. Okay, sounds good. So let's just, I will ask the last question and then we go to the masterclass, the pitch deck masterclass. That's another journey.
Sure.
And we need to discuss that for sure in a little bit further details. So what's your long-term vision for OpenVC? So what would you consider to be a success, say, in 10 years? What the OpenVC should look like in 10 years? Maybe you can give a little bit of
Mm.
numbers. How would you envision
Yeah.
your success, your
Yeah.
desperate success?
Yeah. I saw this ad by Stripe today, and it said Stripe powering 1.3% of global GDP. You know, and I thought that's a really nice line, and I'd like to be able to say, OpenVC powering 20% of the global deal flow, right? I'd like to be the infrastructure. I mean, it's the first word you said, and it really struck a chord because I love it. The pipelines are the infrastructure for deals at early stage, and I think our model allows that because it's predicated on us not taking a cut on anything. So people are, and we're not a VC. We're not like, we're neutral, right? We're not. That's also why we don't build too deep, because if you build deep, you start to step on people's feet, right? We don't want that. We want to be friends with everybody, have a very shallow product, but very broad,
Hmm.
like cover a large amount of deals. And yeah, and once you become a major gateway, um, things become much easier, right, for everyone, for both sides, and it becomes like a good thing because both sides use the product, everything's standardized, and it just makes everything more efficient. At the end of the day, I think, again, I'm a huge nerd. I love efficient things. I love when it's smooth and clean. And so if I can bring that into the messy process of fundraising, that'd be great.
You envisioned like 20% of all deals being financed by at least once by OpenVC. I would say probably, if I may, uh, how would I probably measure success of OpenVC is not number of deals and not the size of investments, but whether there will be one of 10 largest companies in 30 years from now, largest in the world, like new Googles and new Nvidias, that raised money through OpenVC. I think that would mean the biggest success. I mean, you might not have like 20% of all funding, but if there is one company which is like new Apple or new Google or new Amazon that was financed by OpenVC, I think that's what measures the success in venture business. Not about numbers, but one or two this unique uh, projects that made it through to the top, right? So I
Oh,
hope
yeah.
that there will be some.
Oh, definitely. I'm down with that, man. You don't need to sell it to me. I'm okay with that. I think
Good.
at some point, but here's the thing. At some point, it becomes a numbers game. If you process enough deal flow, it's just going to be statistically, you're going to have some winners because you're indexing the market. So for me, if I like, I cannot predict today. Nobody can really predict, and some people try. Nobody can really like systematically accurately predict the winners. So I'm not chasing the winners.
Nobody.
I'm chasing the
Mm-hmm.
volume.
Mm-hmm.
Exactly. And I'm chasing the volume. And if I
Mm-hmm.
get enough volume, I'll get some winners in the pack. Right.
Mm-hmm.
So that's my approach to this. Like, not very sophisticated, but the math works.
And the truth is that if you look into uh, top 10 world best companies, that uh, like Magnificent Seven, for example, they were backed by VCs which were not known at that time, because established and well-known VCs didn't invest into those 7 companies for the reason that it was so much unknown, that it was so much unconventional, that they just passed on these deals. There are so many who passed on Nvidia. There are so many who passed on Google. There are so many who passed on Apple, name it, right? So these VCs became famous just because they invested in those startups, in those companies. And
Yep.
those who were famous back then didn't invest in those 7. So I think that
Exactly.
exactly shows that hitting this right target is extremely difficult and challenging. Yeah.
Yeah.
So, and it's very
We'll
unconventional
see. But
in a way.
that's, yeah. But I think as long as you have the volume and the brand and the trust, this is very important. Having the trust of people, then you can build a lot of cool stuff on top of that, right? If down the road you want to, like, can become a data play, right? Can become an equity play. Maybe, I mean, something I'd like to do in 2026. Now we're starting to really have enough free cash flow. I'd like to reinvest from our own profits into OpenVC startups. Just pick
Mm-hmm.
10 startups, put 2,000 in each
Mm-hmm.
every month, and create
Mm-hmm.
kind of index or whatever.
Mm-hmm.
We'll see where it goes. I don't know, but for me, like the foundation for all of that is going to be like the brand, the data, the volume, the trust. Then after that, and having some cash to play with, right? And then we'll figure it out. And it's okay. We're a small team. We're flexible. We'll find what we can do. But that's my vision at the moment.
Well, it's a very compelling vision, I believe. So let's go to a masterclass. And unfortunately, we don't
Mm-hmm.
have much time, but I want to still to deep dive into this little bit. So you reviewed, you famously known as a person who really dedicate a lot of time and effort into just helping, and that's what OpenVC is all about, helping founders uh, to process the fundraising part.
Yeah.
as easy as possible, but also to demonstrate to them that it is a very systemic work to be done. So maybe you can start with the errors, mistakes. You reviewed obviously thousands of pitch decks, and what is the single most common mistake you see the founders don't realize they're making through fundraising process and pitch deck? So what is that?
Yeah, I think this is a very important question because founders bet so much on their startups and their fundraising, and yet they keep making the same silly mistakes. So, well, I mean, there's a million of them. It's not like one major one. It's a million. There's a million ways to send a red flag. And for investors, it's obvious because investors spend their time doing this. For founders, it can be surprising, right? They don't understand that if they send a deck and the deck is dated of 4 months ago, it's not a good signal, right? If they send a deck and the deck is 30 pages long, it's not a great signal. If they send a deck and it's the full story written in font 12, with walls of text, not a great signal. If you there's a million things like that, and it's not that those founders are dumb. I always say there's no fundraising secret. There's only poorly informed founders, right? And so as a founder, your job, if you want to raise funds and you've never done that before, your job is not to build an investor list and cold email VCs. First job, climb the learning curve. You are at the bottom of a learning curve and you have to climb to run as fast as you can. Maybe it's just spend a weekend, like watch YC School, read OpenVC, right, the blog and the masterclass, all that stuff, and try to run as fast as possible. Understand, okay, you're not going to send an NDA to a VC before you send your pitch deck. It doesn't work, right? You're just sending red flags, bad vibes, etc., etc. So that's kind of and you're right on the systematic approach. Like, because 80-90% of that is always the same stuff again and again, always same mistakes again and again. And so by being systematic, just going through a checklist like a machine, you can go from a bad deck or bad deal to a top 20% or top 25%. After that, yes, the last 10%, 20%, manual work, refinement is a bit art, right? But the bottom 80% is just science. It's just mechanic stuff, systematic stuff. You apply it, your deal will look better just because. Right? Market size. If you cannot say your market size is like $50 million. That's not VC backable. Now, maybe it is, and you shouldn't raise funds. But maybe, you have to redo your market sizing the right way and realize that, it's actually much bigger. So there's a million things like that. Don't say that you have no competitors. Of course you have competitors. And again, VCs, a lot of times they don't even, like for them, these people are not even founders, right? These are not deals they would even consider. Like bottom 50% of founders. VCs don't look at the bottom 50% of founders. They don't consider them. I work with all sorts of founders, from top 0.5% to bottom 0.5. And so I try to serve everyone. And for some people, it means, yes, fundraising, intros, outreach. For other people, it means empowerment, education, homework.
How big the deck should be? What's the best kind of size? Should it be like a smaller, bigger? What would your recommendation be?
Well, I'd say anywhere from 6 to 15 slides, and the stronger you deal, the less, the fewer slides you need.
Less slides.
Because, because if your deal is really strong, you just say, okay, the team is Elon Musk and, I don't know, and Jeff Bezos, right? Traction, we're growing 500% per month. And here's our email address, end of the story, right? That's if you're really strong. And the best deals, it's not a deck. The best deal is a WhatsApp message. I mean, we're probably in the same WhatsApp groups, where all the best deals are done, and you receive a message, hey, I'm leading around in these guys. They're just doing amazing. There is 500K left. Who's in, right? And that's how the top 1% are done. There's no deck. There's no slides. It's oversubscribed, before it hits the market. But
To
that's
what extent actually founders should exaggerate? Because what I'm always saying that, but I mean, you are selling. I mean, you're a founder. You're selling a future, right? Selling a future is easy, right? Because you don't know what the future is, so you can elaborate upon future. So what I advise founders to do, like early stage founders, is to do a lot of A/B testing, right? Because you don't know what exactly your investors will buy, right? No, neither you know what you're going to build. So you will pivot like thousands of times before you really find your product market fit. So your your goal today is to raise and not to predict the future, right? So therefore, like selling future is easy. So your task is to raise money. It doesn't matter what you say, right? You just need exactly what you mentioned to impress the investor in a way, and that's how investor will give you money. But there is a still, like, I mean, a tiny border between where you are telling the future and believing in it, and where you're telling the future and it's like a full, like an ultimate lie, right? It's not like a deep truth you're talking about. So, uh, how to build it the right way? How to make it really exciting and not to make it fake, because nobody wants to sell a fake story, right? I mean, at least people who
yeah, and you should not.
who
And you should
respect
not.
themselves, right? Yeah. So where
Yeah.
to stop? How would you define where you need to stop? Like period, you should not like exaggerate it further.
Well, so number one, like you said, don't lie, right? Because it's gonna come back and bite you. And your name is your most valuable asset. Right? You can close a startup, start another startup. Your name will follow you. So don't. And number two, investors will figure out 99% of the time. Like they have seen everything, right? We've seen, the guys tell you, yeah, we're growing, 100% month over month. And then, okay, so what's your revenue level? Oh, we went from $1,000 to $2,000 a month, right? Like all this kind of, how do you say in English? Um, like playing a little bit with the numbers. But as soon as
Mm-hmm.
you scratch the surface, we figure it out. Okay, we have 1 million app downloads. Cool. What's the retention? Oh, the retention is bad. What a surprise, right? All those vanity metrics. So I don't think, I mean, at the end of the day, the investor is responsible for their money. So if you lie and they invest in you, good for you. They're bad investors. They're doing a bad job. It's not your fault. It's their fault. You shouldn't do it, but everybody is responsible for themselves. But I wouldn't do that. I wouldn't do that because my name is an asset and I build it up over time. That compounds over time. So I wouldn't do it. Don't lie. Honestly, I don't think there's a lot of room for exaggeration. I think the hardest thing is that a lot of founders actually don't know how to make their story sound sexy. I think that's the actual problem.
Mm-hmm.
They don't know how to speak the investor language. They will, like, they have something that could sound cool, that could sound exciting, but they just don't know how to tell the story in a way that is short, condensed, that builds upon market trends, that vibes the recipients frameworks. So investors have, I think that's a big one. Investors have frameworks, right? They're checking boxes at all times. And when you express, I'll give you an example. When you express yourself in your deck, you want to say it in a way that will tick a box in the head of the investor. So one example I give, the ask, the slide where you say, okay, we're raising $2 million. Usually they say we're raising $2 million to build out the product and grow the team. Nobody cares. Nobody cares. That you have the use of proceeds, the pie with 20% marketing, 30% sales, 50% tech. Right? Nobody cares. It's always the same thing anyway.
Mm-hmm.
What we care about is, will you be able to raise again in 18 months? Because if I invest in your seed round, what I care about is,
Mm-hmm.
will you be, fundable for Series A? Because if not, then my investment is dead. And so what I want to see in the title,
one of my partners is like kidding that the main job of investor in a startup is to find the next investor
yeah,
who will
absolutely.
invest at a higher price.
Exactly. Yeah. I mean, you buy and you sell, and you just holding the shares for. I mean, it's a bit more than that, but we understand each other, right? That you buy and sell, and so in the title of your slide, you say we're raising 2 mil to hit, I don't know, 5 million ARR in 18 months, and we both know, the both sides of the table, we understand that 5 million ARR makes you very appealing for a Series A in 18 months. And
Mm-hmm.
so indirectly, you're telling your investors, I understand the game. I know what game we're playing. We're playing the game where in 18 months, I raise again, and you can mark up your participation in my round. So you can raise again from your LPs, right? So you're happy, I'm happy, and you have a partner in bed with you who gets it. A lot of founders, of course, don't understand that.
Indeed, I totally agree. So my two other questions, and then I will come to like closing, and I have one very important thing to ask. So obviously, fear of missing out is a main driver for, well, really it's likely main, not one of the few main drivers, but the main driver for a venture capitalist
Yeah.
to invest. So as a venture capital manager, I learned early enough that losing $1 on the dollar investing, dollar investment is painful, but still like is the name of the game, right? You will lose
Yeah.
as an investor. So I mean, it's painful to a certain extent, but you are prepared to lose $1. What you're not prepared to is when you look into deck, talk to a founder, and then you decide not to invest this $1, and then all of a sudden you, like in 10 years time, you open a feed, and then you see this founder going public or selling his company, and you easily compute that you could have made $10,000 on $1 invested. And that's what
Yeah.
you are driven by. So how to create this FOMO effect, this fear of missing out effect in the right way? What founder
Yeah.
needs to do to motivate in a positive and negative way, whatever it is, through FOMO, an investor to put money?
So this is a great question, and one that we really had to ponder when we built a feature on the platform called OpenFlow. So, there is a lot of startups now, they have this web page where they advertise their startup, right? And they share that link with investors. So the startup, the round is visible. I don't think that's a great idea, because then you like meat on the shelf, right?
Mm-hmm.
You're exposed to anyone, and it's not exciting for investors. They like I said, the FOMO. They like the hunt. They like to feel that they had to fight, or they found it and it's not available to anyone. So we have this feature on the investor side. So that's OpenVC for investors, where you can see a flow of all the deals on the platform. Okay. But you don't see the name of the company. You don't see the name of the founders. You just see a short description, like
It's a
the
blind.
company,
It's kind of a blind
builds AI
choice,
for whatever.
not to create a
And you
bias.
see and say again, sorry.
I mean, it's a kind of a blind choice, right? So you abstract it from like any bias, right? So that's the reason you're doing.
So, and then under the description, we add some positive signals. For example, and you can check it out right now,
Mm-hmm.
openvc.app/flow. So the
Mm-hmm.
startup is AI for whatever. Exited founder, 9 figures.
Mm-hmm.
Growing 40% per month, right? And then request deck. You have a button request deck. And so it's the investor who reaches out to the founder. So the founder is in a position of strength and in a position also of privacy, because they can pick and choose. They see, okay, investor Johnny wants to speak, wants to see your deck. Do you allow? And then you reply back and you start a conversation. Or do you refuse and you remain anonymous? And so this works super well. I mean, the metrics are off the roof for this feature. We have like over 95% open rate on the pitch decks when investors request those decks, because they're like, I want to know, I want to see what's going on. So this is really, really cool. But again, a lot of founders are not happy. They just, why I don't have a page on OpenVC where I can publish my startup and every investor can look at it, because they don't understand the psychology of investors. And yeah, we try to figure that. So that's one way. I guess the bigger answer is retaining information, like selecting information. Don't share everything on the first date. Build up interest, right?
Yeah.
That's why
Create
your deck can be only
some
6 slides.
secrets. Mm-hmm.
Yeah, exactly. That's why the deck can only be 6 slides, because the goal is just like usually you have only 1 or 2 really good things to say. The rest is standard, right? Market size is pretty standard. Competition. I mean, it could be any startup. You can be any startup. You're going to have the same market slides, competition slides. What's going to be different is the team and the traction.
Mm-hmm.
Maybe you have some
And
IP.
your story,
Maybe
your personal story.
yeah, maybe
Mm-hmm.
maybe you have very unique, exactly, angle to that. But
Mm-hmm.
yeah, so but a lot of founders have this belief in their head. If I say everything, if I explain everything, they will understand, they will
Mm-hmm.
see it like I see it. And they tend to
Mm-hmm.
overshare and overwhelm the investor with tons of details that don't make a
Mm-hmm.
difference.
You are advocating for data-driven storytelling. I'm with you. I'm also uh, uh, about like data, but more and more I feel that your biggest differentiation is not data. Your biggest differentiation is your passion and the way you think about your journey. And you should like mix these two things to create a perfect dish, right? Create a perfect deck. Your data-driven approach showing like optically how good you are on a data scale, but also giving your personal storytelling, why you are here, why you are
It's
building what you're building, what's your passion, why you're obsessed with the problem, right? And why you love the
yeah,
problem so much that you will never stop tackling.
yeah. But it's really hard to convey passion through a deck, because 20 years ago it was a different time. You could cold call investors, cold call, not
Mhm.
cold email. You could meet them, on the Sun Hill Road.
50 years ago, like Steve Jobs did, you could have called Hewlett or Packard, whomever he called, and asked for like spare parts. And this very foreman gentleman will just deliver you spare parts, right?
Exactly. Exactly. Today, it's all intermediated by writing. Right. So you're gonna have pitch deck and emails between you and the person. And now there's even a third layer, AI. So more and more investors run your deck through AI before they look at it and get it scored, just to
Mm-hmm.
know if they should even open it or not. And so
Mm-hmm.
you're not gonna be able to express a lot of passion for a deck. I mean, you can do some storytelling, of course, but you're going to be limited. And stuff that used to work 10, 15 years ago don't work anymore, because it's like advertisement. We're immune to advertisement. It doesn't work so well on us. So now what I think more and more is that the storytelling part is moving from the deck to social media. So you're still going to do storytelling, but you're going to do that on X. You're going to do that on LinkedIn,
Mm-hmm.
right? And it's going to help you build up your brand, build up
It's a
awareness,
storytelling,
gain some.
storytelling on steroids.
Exactly. Every time you post something, you're building your story for investors to see. And that's what I tell founders. You want to raise, build your shortlist. Then first thing you do, you're gonna follow every investor of your shortlist on LinkedIn and Twitter, right? And activate notifications when they post something. You're gonna reply. You're gonna engage. You're gonna build up your mind share. And then when you reach out to them, they already know who you are. They already have a feel for you. So it's inbound fundraising, and some founders are really good at that. That's how you can build an expensive storytelling, and raise, even from, from chair.
Thank you, Stefan. It was very insightful. My last question, probably the trickiest one, and I don't have an answer to that, but I hope you do. So, just coming back to like history of like innovation, people believe that invention of credit and facilitation of like debt economy was the biggest invention of of industrial revolution era. So through credit, everything we know was built like through credit in the last 250 years, right? Uh,
Mm-hmm.
Venture investment was the single innovation that brought startups into stage, and venture capital so far has delivered um, every second company in the US that went public in the last, I think, 20 years was backed by venture. And we see
Mm-hmm.
7 out of 10 companies, largest companies in the world, like this Magnificent Seven, were venture backed. Do you think there is
Yeah.
any disruption to venture capital itself? Not the way venture capital is distributed, but is there something what may come uh, to uh, replace the venture capital overall that would impact the world even uh, further through its like innovation journey? Uh, uh,
Mm.
Indeed, the most impactful projects now could not get venture capital, right? Because venture capital is all about turnaround in like 10, well, 15 years, but not further. How to make it work for those projects which are very impactful, but may deliver value in say 30, 50 years. Is there anything you envision what will make that happen? Uh, any thoughts on that?
So the short answer is, I don't know, and I probably just don't know enough to give you like a full-fledged reply. We can think about a few things. So you describe, like, you're talking about innovations for the next 20 to 50 years, and yes, that's outside of the typical VC scope. But when we think about the funding of innovation, it's like a funnel, and you have like fundamental research and research, right? That is done in universities with public funding, so it's already funded, right? Or also inside large corporations, you have very large corporations that have like fundamental research labs.
But it looks like
So
they failed to innovate. If large companies would make it, they would never go out of stage, right? But what we see now is that Google could not do ChatGPT or social networking like Meta. Meta could not do something what others. I mean, it's like every cycle of innovation is happening in startups. I do believe that it will never happen in big companies. So big companies are good uh, for sustaining and buying startups and then building on top, but not innovating. I worked for large companies, so I know it's like almost close to
yeah,
impossible to innovate in large companies.
yeah,
Too much risk.
and I think it's fine. Yeah, and I think it's fine, right? Because then there's an incentive for the small guys. Like, you
Mhm.
want to build your small startups because you can be acquired by Salesforce or whoever for $1 billion plus. So it's exciting for you, and you have an incentive to do it. And yes, you're right. Big companies don't innovate so much, but it's not their role, right? Their role, they're managing huge P&L. All they have to do is, improve by 3% for the next year, right? All they need is an incremental. If they increase revenue by 1% and decrease cost by 1% across the whole organization, that's good. They're here next year. They're here year after. They have 200,000 employees across 50 countries. It's a different game. They're not here to innovate. I'm more interested about fundamental research, stuff that happens in universities, in labs, public funded. I think we could do much, much better on this front. I mean, I'm French. French research, we have great brains, but the funding is ridiculous. Because, of course, it's like you said, it's a very long-term game. And it's hard to spend tax money on this kind of stuff because, you could spend on, if you ask people, okay, we have $100 to spend, do we spend $80 on, developing new whatever plasma materials or quantum computers or, pensions, benefits, roads, at the end of the day, it's a society choice, right? Because you're asking society where to allocate that money. So
I was thinking maybe investing in people rather than projects. So there is an individual, say Stephane, who is outperformer, 0.001% of the crowd in say math or physics. So you can just finance the person without financing his venture, right? So let him go and do whatever is right. So if he does something in his lifetime, then you share some of what he has built. So that's how I would envision more granular venture capital going to individuals rather than just projects, right? So you identify a person and then you give money to person and then you hope that this person will do something real great.
Yeah. I like the idea. It comes with a lot of philosophical questions, right? Because you're owning a little percent of a human being, after all, and are you entitled to their children, right? Because if they produce something, they produce kids, and the kids, next Bill Gates, right? So, but I like the idea. But I just don't know if it belongs to a venture capital system or maybe to a more charitable, foundation-driven, mission-driven system, or even a tax-based system. I mean, it becomes a much broader question. I think venture capital is, yeah.
Mm-hmm. Sorry, go ahead.
No, I just feel that venture capital is just one way to finance things, and we can be very creative when it comes to financing. So I don't know if the venture capital model is actually a super niche. I mean, venture capital is a very niche asset class at the end of the day.
Niche.
It's super
it's
small.
Very small. Yeah.
Look at private
it's
equity.
less than $1 trillion. Yeah. Compared to hundreds of trillions of dollars of the rest of the economy, it's nothing. And it's very aggressive, right? I mean, it builds great companies. It's extremely aggressive, and it's tiny. Yeah.
Yeah. But it works relatively well for what it does.
Sorry.
No, sorry. I'm done. Go ahead.
Yeah, I think, Stephane, that the truth is that, I mean, there are 100 billion people lived. Human beings lived in this world through the journey. I mean, the humanity, right? So probably there are only million who made this world look what it is, right? For good or bad. So so venture capital is all about finding those this tiny percentage of people who can change the world. And I don't know exactly what is it driven by. I mean, is it genetics or it's obsession or something else. You never know, right? But the truth is that it's a tiny percentage of people who has changed the world to what it is. I don't want to say to a better place, to what it is, because we don't see what it could have potentially become without these people.
Yeah.
Uh, but indeed, these changes are made by only tiny individuals. So that's your task.
Yeah.
That's my task, regardless of the way we source for those individuals who can make it or break it. Yeah.
Yeah, absolutely. We're enablers. I'm not smart enough to build, the next nuclear technology. I know that. But what I can do is I can try to connect the two guys who will build it and invest in it, or maybe I can at some point invest myself in it and just help it happen faster. Advise people, unlock potential for other stakeholders, founders, investors, whoever it is. So that's what we can do. I mean, that's what I can do at my own scale, at least. But
In
yeah,
me. Yeah, I totally agree. So that was Stephane Nasser, co-founder and CEO of OpenVC, and Victor Arlovsky, co-founder and managing partner of R136 Ventures. And this was podcast Ventures from the Valley. Listen to us, subscribe to us, and join our community. Thanks, Stefan. It was like really exciting discussion, and I liked it so much. It is one of our longest podcasts, but I'm sure it deserves it, and it was really very thoughtful conversation. Thank you.
thank you, Victor.